I'm very pleased to be here. Today, we raised the policy interest rate by 50 basis points to 3.75%. This is the sixth consecutive increase since March, and quantitative tightening continues and is complementing increases in the policy interest rate. We also expect our policy rate will need to increase further. How much further will depend on how monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding to this tightening cycle. Our decision today reflects several considerations. First, inflation in Canada remains high and broad-based. Inflation has come down in recent months, but we have yet to see a generalized decline in price pressures. Second, and related, the economy is still in excess demand. It's overheated. Households and businesses want to buy more goods and services than the economy can produce, and this is driving prices up. Third, higher interest rates are beginning to weigh on growth. This is increasingly evident in interest rate-sensitive parts of the economy, like housing and spending on big-ticket items. But the effects of higher interest rates will take time to spread through the economy. Fourth, there are no easy outs to restoring price stability. We need the economy to slow to rebalance demand and supply and relieve price pressures. We expect growth will stall in the next few quarters, in other words, growth close to zero. But once we get through this slowdown, growth will pick up, our economy will grow solidly, and the benefits of low and predictable inflation will be restored. Finally, we're trying to balance the risks of under and over tightening. If we don't do enough, Canadians will continue to endure the hardship of high inflation. And they will come to expect persistently high inflation, which will require much higher interest rates and potentially a severe recession to control inflation. Nobody wants that. If we do too much, we could slow the economy more than needed. And we know that has harmful consequences for people's ability to service their debts, for their jobs, and for their businesses. This tightening phase will draw to a close. We are getting closer, but we're not there yet. The Governing Council devoted considerable attention to assessing inflation, inflation expectations, and the balance between demand and supply in the economy. Since June, inflation in Canada has come down from 8.1% to 6.9%. Though welcome, most of that decline reflects a drop in gasoline prices. Inflation in Canada is broad-based, reflecting large increases in both goods and services prices. Looking at indicators of labor markets and economic activity, it's clear that even though the economy has started to slow, it remains in excess demand. Job vacancies have declined from their peak, but remain high, and businesses continue to report widespread labor shortages. With the economy now fully reopened, households want to enjoy many close contact services they have missed, but businesses can't keep up, and we have seen prices for services rise rapidly. Higher policy rates are beginning to slow demand. Higher mortgage rates have contributed to a sharp slowing in housing activity from unsustainable levels, and consumer and business spending on goods is moderating. This has led to declines in house prices and is exerting downward pressure on goods prices. Moving forward, we expect the effects of higher interest rates will continue to work through the economy, moderating household spending and business investment. The Bank of Canada's job is to ensure inflation is low, stable, and predictable. We are still far from that goal. We view the risks around our inflation forecast to be reasonably balanced, but with inflation so far above our target, we are particularly concerned about the upside risks. We are mindful that adjusting to higher interest rates is difficult for many Canadians, and many households have significant debt loads, and higher interest rates will add to their burden. We don't want this transition to be more difficult than it has to be, but we remain focused on our mandate. Higher interest rates in the short term will bring inflation down in the long term. And getting through this difficult phase will get us back to price stability and sustained growth. As we move forward, we'll be watching carefully to assess the impact of higher rates on spending and how this is feeding through to price pressures. We will also be watching to see how global supply disruptions resolve and to what extent this translates into lower inflation in Canada. Finally, we'll be watching inflation expectations closely to assess how households and businesses are responding to slower growth and spending.